So in today's episode, I'm going to share with you the 3 fundamental policies I believe is keeping the Singapore real estate market stable and why I believe it's not going to crash. Okay, if you're new to the channel, welcome. I'm Zoe. I've been a real estate consultant for 4 years plus and counting, and I've helped more than 70 families transit and expand their property portfolio. And my mission is to guide solo home buyers and investors to grow their wealth through property investing. Now, I myself am a believer of the real estate market. Now, before we take a look at the 3 key policies I believe is fundamental for the stability of the Singapore real estate market, let's define what a crash is. So typically a crash is a sudden drop or drastic decline in asset prices, usually over a short period of time, more than 20% drop in most of the cases. So if you take a look at Singapore real estate history, when was the last time we had crashes? So if you were to look back, wind back time, 1996 to 1998 with the Asian financial crisis, that was when the market tumbled by 40%. Then if you move forward a few years, 2000 to 2004 is an accumulation of, number one, the dot-com bubble, you have the SARS, you have the 9/11, the market tumbled by 21%. Then we have the global financial crisis in 2008 to 2009. Singapore real estate market was not spared. The market tumbled and crashed by 26%. And ever since then, after the introduction of the cooling measures, what we have seen are just healthy dips and corrections in the market. So what essentially has helped to stabilize the real estate market, I believe, is not by accident. It is really not haphazard. These policies are birthed out of macro social economic goals, and we have what we call overarching vision that has been dissected into implementation goals. So in Singapore, we have what we call the URA concept plan that runs for 40 to 50 years. It charts out what the nation building is when it comes to the use of land, etc. Then this 40 to 50 years vision is then cascaded into 10, 15 years block so that we track the implementation, keep ourselves relevant. So the first key policy that has helped to stabilize is the cooling measures. Now the cooling measures, till date, we have about 15 rounds of cooling measures since its inception in 2009. Now the purpose of a cooling measure is mainly to make sure that prices are stable and it is always, and that speculation is flushed out. So right now, we have around 16 cooling measures already. It is deeply embedded into our property prices. So even though we see the property price continue to track upwards, these prices have already included all these cooling measures. Now, some of the examples of the cooling measures include, number one, TDSR, total debt servicing ratio, which means that buyers can take a loan from the bank based on 55% of their income for private properties or 30% of the income for HDB. This makes sure that, number one, buyers are not over leveraged, so you reduce fire sales or defaults to the minimum. This is very key because you want real estate market to be stabilized and being supported by home buyers who can afford the loan in long term. Now, number two, we have the ABSD, known as the additional buyer stamp duty. So first part is if you are someone who owns a property and you want to buy a second, third, fourth, fifth property, there is additional tax that will be incurred in growing measure. And number two, if you're not a Singaporean, if you're a foreigner, a PR, a company who wants to buy a property in Singapore, additional tax is incurred. So basically an ABSD is to deter any behavior of investment, is to deter speculation, and to make sure that, yes, if you really want to invest, there is a certain tax that will be incurred. So the government wants to make sure that most of the property transactions in Singapore are for family, for own stay. That creates stability. Because when it is very investment driven, if majority of the home buyers are investors, at a change of the market, you will see them dropping the properties like hotcakes, and that's when a crash would happen. And this is what the cooling measures has deterred, has prevented. You're looking at a market that is stable, mainly made up of home buyers who are staying in a property for their family. And then, of course, when it comes to taking a bank loan, the bank loan is not just a number that's plucked out of air, but it's based on a value that the bank has valued the property at, and not based on maybe the asking prices or the selling prices, but typically transacted prices forms part of the value itself. So before buyers want to get a loan from the bank will send a valuer to the property to assess what is the value of the property. And based on that, buyers then get a 75% loan. That will be the maximum. And of course, whether or not your CPF can be used to what proportion also depends on the property value itself. So if let's say, for example, a buyer were to buy a property that is with a price that's above what the bank valued it, then the loan is based on what the bank value and not what the property transacted price is at. So number one, cooling measures has helped to reduce speculation to the very, very, very minimal. And number two, you're looking at a very stable market that's supported by buyers who can afford the loan in the long term and buyers who are buying properties mainly for own family stay. The second policy that has been keeping the market so strong and stable is the regulation of the public housing. So predominantly public housing are meant to be accessible and affordable to Singaporeans. It is the bedrock of social stability. So the regulation will be there to make sure that it is so for generations to come. So whenever you see flat prices seems to be heading upwards, runaway price, you will see the government stepping in to make sure that supply always keeps up with demand. So number one, how does the government regulate the public housing to make sure that it's always accessible and affordable? By increasing supply whenever the demand is outpacing it. Okay. Number two, it will then make sure that at different parts of Singapore, the choicier units or the choicier new flats will attract a higher subsidies, yes, but it means that the buyers in this more central regions will have to stay longer before they can sell. And when they sell, because they had more subsidies, they will have to then return the subsidies. For buyers who buy new flats in the outskirts, then they will be subjected to the normal standard category. After 5 years, they can sell. Subsidies will not be as much as those of the prime and the plus category. So this levels out the field to reduce any lottery effect, just in case you're a buyer who cannot get a home in the OCR or in the outskirts, and then you have no choice but you get a home in the central, then you are sort of equalized in that sense. Okay, number three, there are also a lot of grants that buyers can take to help offset the cost. CPF housing grant, proximity grant, that gives buyers a legs up when it comes to future upgrading. Whenever you want to buy a new flat or resale flat, it is subjected to criteria such as Singaporeans, family nucleus, and all this plays a part in terms of being able to qualify for public housing. So all in all, why is it important to keep the public housing stable? Is because 80 to 90% of Singaporeans stays in public housing. And the public housing, with the grants involved, with the subsidies involved, buyers who buy HDB flats, when they eventually sell, they can use these grants and subsidies as a legs up, as an advantage, as an additional boost for their down payment for their next home, be it private or a larger resale, etc. So definitely, with most of the population in Singapore staying in HDB, having a stable HDB market helps to perpetuate a stable private market. Because when a HDB wants to upgrade to a private sector, already the grants, the subsidies, the way the prices are valued at in the public housing already create such stability that will help bring stability to the private housing as well. So that's why you see a lot of upgraders from HDB being able to roll their funds into the private homes because of a very stable public housing market in Singapore. Now let's talk about third policy. So the third key policy is on the government land sales scheme, where land is actually put up for developers to bid so that they can build private housing. Again, when the government land sales is being released, which land parcel is being released, they are not done haphazardly. Again, there is an overview of how the land in Singapore is being used, especially when land is scarce. So URA depicts when and where the land is being released. And number three, it regulates the price as well, because there are certain cases when the developers is the only single bid and their bid is too low, URA actually rejects the bid. So there is a sort of benchmark, there is a baseline price that is regulated by URA to make sure that the land is not bought too cheap by the developer, but rather it is keeping pace with the market trends, keeping pace with broader macro goals for the country. So all in all, these three key policies has kept the market very stable with buyers who can afford the homes, and therefore reducing any speculation, reducing fire sales to the very bare minimum. So let's take a look at how the real estate market has performed as compared to the major economic shocks these recent years. So in 2018, during the US-China trade war, that was when the tariffs and the retaliation escalated through the year, the PPI, or the property price index in Singapore, actually rose by 7.9%. Now, what is the private property price index? It actually tracks the increase in prices as compared to a benchmark. Okay, so in 2018, private property price index went up by 7.9%. 2019, there was a global slowdown, and that was when Brexit happened. IMF actually cut the global forecast several times, but our internal private property price index went up by 2.7%. 2020, COVID-19 pandemic, massive lockdowns throughout the whole world, a biggest economic shock since the Great Depression, and of course the stock market crash in March. 2020, PPI rose by 2.2%. 2021, we had the global shortage in supply chain because market reopened. There was also when the Evergrande debt crisis happened. That has caused a lot of fears in systemic crisis, but our PPI has increased by 10.6%. 2022, the Russia-Ukraine war and the energy shock, inflation also surging worldwide. Rates were hiked up aggressively, and there was a historic gas shortage in Europe. Our Singapore private property price index rose by 8.6%. 2023, global banking jitters. You have the Silicon Valley Bank that collapsed in March. Credit Suisse almost collapsed as well. And of course, there was a lot of fears for the global banking system. Our PPI increased by 6.8% that very year. 2024, you have the Red Sea shipping attacks. Inflation remains sticky, remains high. PPI increased by 3.9%. And 2025 till date, you have the China property and debt crisis still ongoing. You have the AI bubble burst, fears that's still ongoing. And of course, geopolitical tensions are at an all-time high. Our property price index for the first half of 2025 has increased by 1.3%. And second half, you can already see with the new launches that's been doing very well, we can expect it to continue to grow. So therefore, what we're looking at is a very stable Singapore market or real estate market that has sort of buffered ourselves from the global crisis. Also because the Singapore real estate market is primarily driven domestically by buyers who can afford their homes because of all these very tight cooling measures. So all in all, I think before we end this, I think a lot of you will be asking, will prices continue to go upwards? Because it does sound like it. In my humble opinion, I feel that as long as we're running on fiat monetary system where our currency is backed and issued by governments, and that the value of our currency is always driven by supply and demand, where governments can print the money to stimulate economy, then inflation will always be a concern. And if inflation is essentially an eroding of purchasing power simply because there's too much currency in the market, whenever you see low interest rates like right now, there will always be a fear of inflation down the road. You will see people cashing out of their stock market, or they will just take advantage of the low interest to park their funds into assets that can hedge inflation, for example, real estate, gold, silver. And so you have seen these prices rising in tandem when interest rates are low and when there is a lot of liquidity in the market. So I think as long as there is inflation that has to be managed, people will always choose to park their funds into real estate. And that's why I think the prices will continue to grow. There is demand to hedge inflation in those assets. Then finally, if you are thinking about maybe buying a home in future, or if you're thinking about upgrading, then your question is, will I then be able to do so in future if the price keeps going up? Then there are two camps of thought. The first camp is perhaps some of you will then perhaps rely on your salary to keep pace with the property prices. All and well is good with that approach. It's just that you are putting a lot of eggs in one basket, depending a lot on your active income and making sure that you're just praying and hoping that your salary always keep pace with the property prices. Another school of thought would be to diversify them both. That while your income continues to keep pace with property prices, all is well and good, you can also divest your funds into assets that hedge inflation like real estate, gold, silver, so that it can also be growing in tandem with inflation even while you're not working. For me, personally, I am in the second camp. I believe in diversifying. I believe in taking advantage of knowing. I believe in making sure that my money is working harder for me, that essentially my purchasing power is not eroded over the years by inflation, and that my purchasing power is in future is in tandem with the inflation. Yes, I have active income, but I also want my asset to continue to increase in value so that all in all, my purchasing power will not be eroded by the time it's 20, 30 years down. So I hope this video helps you. And if you're thinking of whether or not to upgrade, whether it's the right time, take a look at my next video.